Welcome to UPSCpractice.com. Today, let's take a look at Reserve Bank of India (RBI). So what is the Reserve Bank of India? The Reserve Bank of India is a central bank of India which was established on April 1st, 1935 under the Reserve Bank of India Act. The Reserve Bank of India uses monetary policy to create financial stability in India. It is charged with regulating the country's currency and credit systems. Understanding the Reserve Bank of India is important for various competitive exams. Located in Mumbai, the RBI serves the financial market in many ways. The Reserve Bank of India sets the overnight interbank lending rate. The Mumbai Interbank Offer Rate, or MIBOR, serves as a benchmark for interest rate related financial instruments in India. The main purpose of the RBI is to conduct consolidated supervision of the financial sector in India, which is made up of commercial banks, financial institutions, and non-banking finance firms. Initiatives adopted by the RBI include restructuring bank inspections, introducing off-site surveillance of banks and financial institutions, and strengthening the role of auditors. First and foremost, the RBI formulates, implements, and monitors India's monetary policy. The bank's management objective is to maintain price stability and ensure that credit is flowing to productive economic sectors. The RBI also manages all foreign exchange under the Foreign Exchange Management Act of 1999. This act allows the RBI to facilitate external trade and payment to promote the development and health of the foreign exchange market in India. The RBI acts as a regulator and supervisor of all the financial systems. This injects public confidence into the national financial system, protects interest rates, and provides positive banking alternatives to the public. Finally, the RBI acts as the issuer of national currency. For India, this means that currency is either issued or destroyed depending on its fit for the currency circulation. This provides the Indian public with a supply of currency in the form of dependable notes and coins, a lingering issue in India. In 2018, the RBI banned the use of virtual currencies by the financial agencies and banks that it regulates. Some special considerations. The RBI was originally set up as a private entity, but it was nationalized in 1949. The Reserve Bank is governed by a central board of directors appointed by the national government. The government has always appointed the RBI's directors, and this has been the case since the bank became fully owned by the Government of India as outlined by the Reserve Bank of India Act. Directors are appointed for a period of 4 years. According to the RBI website, the current focus of the RBI is to continue its increased supervision of financial institutions while dealing with legal issues related to bank fraud and consolidated accounting and attempting to create a supervisory rating model for its banks. Let's take a look at some of the important highlights of the working policies of the current RBI Governor, Mr. Shaktikanta Das's speech.
Every financial institution, and in particular the banks, they have to do a COVID stress test, and I'm aware that many of the banks have already initiated this exercise, and each bank is expected to undertake this COVID stress test, identify what kind of vulnerabilities they have, what kind of challenges they are likely to encounter, identify the vulnerable points, and raise capital in time. I think that is very crucial at the moment, and that is something which the banks are expected to give topmost priority, and I'm aware that many banks have already started this process.
The need to recapitalize banks.
The economic impact of the pandemic due to lockdown and anticipated post-lockdown compression in economic growth may result in higher non-performing assets and capital erosion of the banks. A recapitalization plan for public sector banks and private sector banks has therefore become absolutely necessary. While NBFC sector as a whole may still look resilient, the redemption pressure on NBFCs and mutual funds also need close monitoring. Increasing share of bank lending to NBFCs and the continuing crunch in market-based financing faced by NBFCs and HFCs also needs to be watched very carefully.
Some relaxations, not the new normal.
At the central bank, we strive to maintain the balance between preserving financial stability, maintaining the banking system's soundness, and sustaining economic activity. Post-containment of COVID-19, a very careful trajectory has to be followed in orderly unwinding of counter-cyclical regulatory measures. The financial sector should return to normal functioning without relying on the regulatory relaxations as the new norm. The Reserve Bank is making continuous assessment of the changing trajectory of financial stability risks and upgrading its own supervisory framework to ensure that financial stability is preserved.
Some of the different policy rates and reserve ratios used in RBI are repo rate, reverse repo rate or RRR, statutory liquidity ratio or SLR, bank rate, liquidity adjustment facility or LAF, cash reserve ratio or CRR, open market operation or OMO, marginal standing facility or MSF. There are also some qualitative tools used by RBI. They are margin requirements, selective credit control, modal suasion. Thank you very much for listening to this article on the Reserve Bank of India. For more such articles, get the UPSC Practice app from the App Store.